Today I'm here to talk about the last export incentive that exists in our Internal Revenue Code. This incentive has been around since 1971. It was revamped in 1984, and because of the Bush tax legislation that passed in the early 2000s, this regime really became effective and a part of planning for a lot of U.S. exporters. This incentive, known as the Interest Charge Domestic International Sales Corporation, many of us in the field of international tax will just reference it as an acronym IC-DISC, D-I-S-C. But this regime, in essence, allows U.S. exporters of produced goods in the U.S. or extracted goods in the U.S., such as agricultural products or any certain types of minerals and hard resources, as well as things that are grown or constructed. But those items that in essence are produced here in the U.S. and have an ultimate use outside the U.S. or exported outside the U.S. For use outside the U.S., this incentive allows those exporters to carve out and have approximately 50% or half the export income subject to a reduced effective tax rate. And the IC-DISC is the regime in our tax code that allows for that. This incentive is really geared towards helping small and mid-sized exporters, not your publicly traded companies. Although they can use it, the tax benefit is diminished. And for those small and mid-sized exporters, they need to ask themselves a couple of questions before they begin exploring whether or not they want to incorporate or explore having a DISC part of their overall tax planning strategy. The first one is, do we export? Or are our products ultimately used outside the U.S.? That's the first question. The second question is what is our current export volume? That's the next one, because obviously there's a cost to set up and then a cost to administer this, and we want to make sure that the benefit is going to exceed the cost to administer and set up. The next question is of my export volume, what is my net margin, or what is my profitability on those exports? If I'm not profitable on the exports, then the regime's not going to help significantly. You really need to be profitable in order to benefit from this. Once you know the answers to those, as long as your exports are roughly around $1 million or greater, or the net export income on your exports is $200,000 or greater, then more than likely there's going to be an opportunity there for you to take advantage or implement the IC-DISC regime. And it's also important to understand that the IC-DISC, the way the regulations are written, it's really invisible to your operations. So you don't have to change operations, you don't have to change invoices. In essence, to boil it down in simplistic terms, the DISC regime allows you to set up a special purpose entity, a domestic corporation that is tax exempt from corporate taxation. And the manufacturing company or the operating company pays a commission to the DISC, of which the regulations determine what is that arm's length commission payment. And therefore you're reducing the corporate or operating company's business income in the form of a commission expense. The IC-DISC, which is a domestic corporation that is elected to be taxed as a special purpose entity under our tax code, is tax exempt, so that income, that commission income, is not taxed in this entity. And we convert the income to qualified dividend income, which is ultimately distributed to its owners, the shareholders of the DISC. And by doing that, we've in essence converted trader business income, which is taxed at a maximum of 35%, over to qualified dividend income that's taxed at a 15% rate. And therefore we have the arbitrage of 20%, and for pass-through operating companies such as an S-Corp or an LLC or partnership, it's going to be a 20% arbitrage. If it's a C corporation that owns the operating company, then it's really going to be roughly 30% or 29.75% arbitrage, because what we're doing is we're moving double layer taxation. We're creating expense, we have income, and we're distributing that income to the shareholders, but there's not a corporate level taxation on half the export income. Again, I would encourage you, if you have clients that have export activities, to explore the IC disc. It's a foreseeable, at least to the future, a viable strategy. The regime's going to be around. It's never been challenged by our trading partners in the World Trade Organization, and the current administration as well as Congress support it. And with the goal of doubling exports by the year 2014, this is one of the ways in which they're encouraging and hoping this can happen. Again, I would encourage you to seek out the IC disc regime and see if it makes sense for your clients.